questions from Sam. So, what sort of property land size can be built for granny flats, and is it a good investment? So, I guess firstly with that one, Sam, there's a few things to unpack with that one. So, in terms of the land size, that is going to be purely dependent on that state and council's regulation. It's different from location to location. I mean, it's going to also depend on how big the house that is already there, how much actual free land is available. There's other problems that you got to consider, like again, you'd need to specifically check the council. It's not really something that we're too interested in as a business. There are some other buyers agents out there or marketeers out there that really push this as the be all and end all strategy. I think if you dig a little bit deeper into that, though, they're also running a building company and some other things associated with that. So got their fingers in a couple pies. But I mean, in general, when you're buying a property and then adding a granny flat, great for cash flow purposes, not going to dispute that. You're normally going to get somewhere between kind of 8 to as high as 14% rental yield by adding that granny flat. But you've got to understand the other problems. So firstly, let's just say you got a property and it's currently valued at $800,000 and the rent's maybe $700 a week. When you add the granny flat, that's probably going to cost you in today's market anywhere from 200 to 250, potentially more, depending on what kind of hoops you got to jump through from a regulation standpoint. Now, the granny flat might rent for anywhere from $450 to $600. The reality is, though, just because you've spent 250 for the build and then you've paid $800,000 for the property, it doesn't now mean you have a property valued at $1,050,000. That's just not the way it actually stacks up. The reality is that you're going to lose equity on that build because they still need to see comparable sales. And like for like transactions either there or nearby, you will lose equity. The value of that property will come back 900, 975. So your equity lost typically on a granny flat is going to be between about 50 to 150,000, sometimes more. Look, I'm not saying that everybody's lost money, but the reality is when those people have come back and said they've made money or they've broke even, if they just kept that property as it was and they had that property reevaluated 2 years later, I guarantee you they actually would have been in a positive equity position versus breaking even. Now, where do the granny flats come into, I guess, or of use? So when you get the new build, you got some depreciation there that can be good for a tax depreciation side of things. But again, if we're looking to create wealth, we want to get wealth through capital growth and leverage, but it's just more of a byproduct of that. The rental yield will be quite strong. So I guess where it does come into vogue in terms of adding granny flats is if you've built up a property portfolio, but you're now wanting to focus purely on cash flow. You've got multiple assets and you've got really good capital growth producing assets, but now you're concerned about cash flow. This is when you might come back, your servicing's gone, but you've got access to cash or usable equity and come back and build those granny flats. But again, you are not going to increase the equity on those sites. You will increase the cash flow quite a bit. You will get some depreciation on it, but also understanding too that you will bastardize your property. So in general, the people that are going to be interested in a property with a granny flat are going to be people with older kids or older parents living with them. They'll kind of live separately, or other investors. So you're removing out a lot of home buyers. Not everybody's going to feel comfortable with the weirdo living out the back whilst their kids are kind of out and playing or their pets are out and playing. So you are going to bastardize your property. But then you also got to understand you're also going to impact the rent on the initial dwelling. Like you're not going to slice off a chunk of land and think that you're going to maintain the rent. Now, you might be able to maintain it because the market rent has increased and you can keep it as is, but essentially you have lost out on rent there if you flick it in reverse. So in terms of when to use it, I'd be using it towards the end when you're more focusing towards cash flow, because it's not really there as I guess a capital growth, equity growth position. Anybody saying that is not doing their actual numbers and due diligence and don't really understand the market. That growth is coming from capital appreciation in the area. The other thing to just keep in mind as well, which isn't really reflected here, is your actual building and holding costs. So if you're going to go out and get the granny flat built, you're going to have to get a construction loan, and then you're going to be building that property for a period of time and paying that loan down as well. So there's costs associated. That's not even taken into count the equity loss. So again, great if you grit your teeth through it and do that, and you might then have a property that keeps its head above water longer from a cash flow perspective. But again, you are going to decrease the equity position and bastardize your property. So thanks for flicking that one through.